Good afternoon. Thank you for attending. I'm excited to be here at the Mello conference. With me is Sarah Payne, our financial director. I'll go over the business and the business model and talk about what we're all about from an investment thesis perspective. And then Sarah will review the 2018 numbers as we reported them. Then we'll reserve about 5-10 minutes at the end for questions and provide you with insights to specific areas of the business that you have an interest in or some question about. So Tern is a company that was put together on AIM through the acquisition of a shell about 6 years ago. And we're an AIM-listed investment company. From that perspective, what we do is look, particularly in today's world, to UK companies where there's a product, a capability, and a management team that has the wherewithal that we believe can be helped, mentored, and brought into the global marketplace. From an experience point of view, I'll talk about it when we talk about the team, but I've had experiences through the years of running public companies in the US where we've acquired UK companies in particular, where there has been incredible technology that has been underutilized, undermarketed, and undervalued. And we're seeing no change in that opportunity for us to do that. So Tern is a investment company looking particularly at UK companies. Now with Brexit, we'll be thinking about looking at some European companies as well to give us that footprint. But from an investor point of view, what we think we're doing for our community of investors is providing you with access to opportunities that you wouldn't be able to do it individually or get access to because the entrepreneurs are looking for investment companies, venture companies to provide them with working capital on a continuum through their success model. In 2018, and those are the numbers we'll report on today, we had a 58% increase in our net asset value. And that, I think, is a significant way to look at us. Sarah will cap off our discussions today with some of the KPIs that you should be looking at from an investor perspective as to what we do. But this is the nature of our business. And in 2016, we made a fundamental change to the original idea. The original idea by the group of guys that were part of the founding members of the team, of which we invested our own capital in. So we're all significant shareholders. I'm at 4%, roughly. I'm a 4% holder. So our alignment with you, the shareholder, is pretty acute in terms of how we look at things, how we spend money, how we work to get a return on our investment, and how we look at the companies we deal with on the basis of their ability to provide us with the results that we're looking for. In 2016, we changed our business model from that of buying 100% of a company and working with that company to build something, and really look to create influential levels of interest in a company, getting a chairmanship, board majority, the things you need to do to create a capability to have substantial influence over that business, but also to reduce our shareholder risk, our risk in that business, as well as become part of a bigger, broader community of other investors such that we can syndicate those deals. If you look at our journey, we started off the business in 2013 with the shell, and in mid-2014, we made an acquisition of a company called CryptoSoft, with an investment of roughly £300,000. And we were the sole owner of CryptoSoft. In 2016, when we decided to change our model and we went out and looked for additional investment, we were able to syndicate the CryptoSoft deal in 2016, do an acquisition of a company in the US in Silicon Valley called Device Authority, Inc., merge the companies together effectively, although we acquired, and syndicate the financing of this business with Alsop Louis Partners, a US-based venture firm. And we went from a valuation, and we marked to market, which is important. So we look at market transactions to create new net asset value triggers. We went from a 300,000 pound market cap with CryptoSoft to I'll do it in dollars because we dollarize it, a $23 million market cap for Device Authority Inc., because we changed the name from CryptoSoft to Device Authority, because love the name, and put ourselves in the marketplace with a capability that was now a US-based venture firm working with us, a public venture firm in the UK, to create a company that is providing security capabilities for the IoT. If you look at IoT and why we're focused on the IoT is in the manufacturing segment. If you look at where the money is going, it's going in two areas specifically in the Internet of Things: intelligent, high-value manufacturing and the digitalization of medicine. Those are the two areas of greatest impact, greatest investment. If you look at what's being talked about here in terms of forecast for the market, it's a sizable market. If we can get 2, 3, 4% of the total all-in market, we have an Uber-like company. We have a company of great value when we invest in these areas. When you look at the medical businesses next year are forecasted to spend something in the neighborhood of $7 trillion in development, to develop new products for the medical area. The two biggest issues in the medical area is lack of data and the time it takes for product adoption. Product adoption is what holds back profit, holds back development within the framework of the medical industry. Same in the industrial industry, but not to the extent that it has in the medical industry, because the medical industry, and it's good for us from an investment point of view, is controlled from a regulatory point of view. We have the FDA, we have HIPAA, we have GDPR. There's a whole series of things that have been built into creating market opportunities that we can leverage to help companies in this space get their products to market faster. And if we're good at what we're doing, also capture the data from these products in a way that they can improve the products and improve medical practices and medical outcomes. So these are the two areas where we as an investor are focused, and why these are really lucrative for us as shareholders is that the big companies in these two spaces are looking at IoT the same way, unfortunately, but with an opportunistic view, that the phone companies, the telcos, didn't look at the internet. If you look at the internet today, it is not dominated by the people who should have dominated the internet. BT is not a big player. Verizon, not a big player, because they were so focused on copper and the fact that you had a phone in your home, and that's what they were going to do. What we're seeing, particularly in the medical space, is tuck in ways to grow their businesses faster by acquiring companies that are doing things in this space. I personally had an investment in a company called QuantaLife. It was a group of guys that we spun out of Lawrence Livermore Labs in Silicon Valley, put this thing together, really focused on amniocentesis and a way to provide a non-invasive way to provide a result to a person in that situation. We sold the company for $165 million 2 years later with just the working product and 2 customers to Bio-Rad because they wanted to be the leader in that space. And so we see this M&A activity accelerating over the next 3 to 5 years. And as a company, we want to be a player in that market. So about the business, our vision really is we want to be the go-to investor that you come to as a young entrepreneur here in Shoreditch to get capital as well as get mentoring to build your business into a global business that becomes exportable, that becomes actively interesting to U.S. investors. We see the VC market here in the UK somewhat broken. And we're not the only ones that feel this way. Draper Esprit, who's a big brother, if you will, to our model, that's doing investments across the board in software, feels the same way. Providing capital through limited partnerships with 10-year 10-year or more holdings to get a return of 2-3 times your money is not that exciting. We believe we provide you an opportunity to invest in companies you couldn't get into even if you were a limited partner, if you were allowed to be a limited partner in a VC fund, and vote with your feet every day. And that's what we think makes it exciting for us and makes it exciting for our investors, in that you get to put your money in or you get to take your money out based on how you believe we're performing. And we're looking for, in an investment perspective, investors who have a GARP mentality, growth at reasonable prices. And that's how we view ourselves today, as a really strong GARP investment that provides capabilities for our investors to grow their capital faster and with less risk than investing in a venture company. Again, story, 2 guys I know invested in over 100 startup ideas from the Stanford Business School. Only one hit, Google. They're both billionaires right now, but they funded those Sergey right at the very, very beginning. But that's 99 failed. So we're taking a more scientific approach to what we do from an investment point of view, and we have an investment thesis. And this is the rigor that we take into how we look at companies. You know, we're really looking for companies with a particular focus in the IoT space. And again, from a journey point of view in history, when we had Cryptosoft that became Device Authority Limited, we have a company that provides security, a horizontal platform that provides security capabilities that are much needed in IoT, agnostic. We don't care about, Device Authority doesn't care about whether you have a MIPS processor, an ARM processor, an Intel processor, whether you're using Linux or iOS. We're agnostic to all those things. So this is an incredibly robust horizontal platform. The bad news is it's a robust horizontal platform that made us early days play in multiple markets and all over the place. And we suffered through the asymmetries of those markets. Today, the company has now narrowed its focus. We're focused on high-value intellectual property products and medical devices. Business is turning, growth is happening. It's a much better environment from the company's point of view, and from our point of view as an investor, a much more structured way to do business. And as a consequence, we now have a rhythm and a cadence there that we're now replicating in our other platforms. The other thing that we do that comes within this framework of our investment strategy is look for companies that provide synergistic value to our other portfolio companies. And you will see, if you go to our website and go to their websites, that all of our companies, either public or soon to be made publicly, kind of do business with each other because we solve problems for each other, as well as we create a conversation between each other that helps us become bigger and better in the markets that we're addressing. And we're taking that and using that as really important leverage for us as an investor and you as an investor, so that these companies and the people in the companies share ideas, share experiences, share contacts as cousins. And it's not a competitive environment. We also will not invest in other companies that will compete against our portfolio companies, because that's crazy. So we really want to create trust within the framework of our investments, if they meet this model, and have those investee companies and those management teams help us and help each other get new investments, as well as create value within the combined entities that they create from a customer point of view. I talked about how we segment our investments, but we segment our investments in these 3 areas. So it's medical and industrial IoT, but then take it down a level, and we're really looking for companies that provide for security in various ways to IoT devices. If you think of the problem that we're facing, the problem in IoT is a real simple one to understand. If you're in traditional cybersecurity, and I'm an old guy, so I go way back to when there was a terminal and you followed the wire to figure out which guy on what terminal was having a problem. Then it was replaced by VPNs, and you had a VPN, which is a virtual wire that you follow the wire to figure out who's got a problem. In the IoT space, they're not connected at all. This is truly devices that act like cell phones, in that today I'm in London and Vodafone knows I'm here. Yesterday I was in LA and Vodafone knew I was in LA. I'm not connected in any other way. That the phone itself has a mechanism to authenticate itself, provide a capability to Vodafone to know it's me. And Vodafone only cares about me because they want to bill me. So, there's a monetary reason for this. In the IoT space, when you're talking about industrial controls on an oil rig in a factory, or for example, in Device Authority's customer 3D printing is worried about two things: protecting their IP of their printers, because certain governments want to steal that for sure, and they're really concerned about making sure that when they update their printers over the air, when they provide new software for those printers, it's protected. And their customers, like Align, the invisible brace people, want to make sure their designs aren't stolen off those printers and go to a country that would gladly build them for 10 cents a copy and God knows what quality, right? So we're solving that problem with Device Authority. NVMA is really focused on the industrial side from a value creation point of view. This is a company that is a little bit of a sleeper for us yet, but making the transition. Spun out from a group that's been 20 years of history of building power plants, oil refineries, factory automation systems. These are engineers that know how to do this. Saw the opportunity and said, my God, all of these controllers are becoming digital. How do we leverage these digital products? And we have within NVMA something called AcidMinder, which is a product that provides a capability to monitor and deliver reporting on things that are in motion in real time. So if I can save having to send a helicopter out to an oil rig by being able to take something offline and wait for the guys to show up when they're supposed to show up rather than have the whole oil platform come down, we're talking about serious amounts of return on investment for those companies by using these digital transformational tools that NVMA is helping develop. And then in the IoT platforms that provide data analytics, FundamentalVR is there, and you kind of go, a virtual reality company using virtual reality IoT tools, how does that deal with data? Quick statistic. Last year in the US, there were 250,000 surgical deaths that occurred in the operating theater. To put that into a different business, that would be the equivalent of British Airways putting two 747s into the runway at LHR every day, 365 days a year. No other industry on the planet can have that kind of morbidity rate and not even have it make the newspapers. What FundamentalVR does is provide a capability to deliver medical training through simulation. Go back to British Air. If I'm flying the British Air route from Heathrow to JFK, every 6 months, whether I want to or not, I got to go qualify again in the simulator that shows me taking off and landing at Heathrow and shows me taking off and landing at JFK. As a consequence, it's a good way to fly because it's not they're not practicing on you. In the medical profession, they're practicing on you. And what we do at Fundamental is really we change the scope, and I'll talk about how we change the scope of the medical business, both from a practice point of view, but more importantly from a data gathering perspective. Because that data that we capture from the fundamental product provides insight to medical companies, insight to insurance companies, insights to patients and hospitals with regard to, is this a good surgeon or a bad surgeon? Is he really up to snuff against his peers around the world? I said we're invested in UK companies. We're invested in UK companies. We have an approach to investing that really says we look for these companies, good management team, reasonable product, so there's no product risk or very little product risk. We want something that is in the hands either through a proof of concept or actual in use before we go in, so that we can really focus on strengthening the management team and really creating a global strategy to take this company into the US. So we work on infrastructure, making sure company's house. Sarah spends most of her time in the front end just getting everything tidy. And that takes forever because young entrepreneurs have no gumption for authority. So we'll still find things a year later. You didn't do this, the company, you got to do this, kind of thing. Growth, now once we've got things, so they do the same things twice in a row, it's nirvana. We go into the growth mode where we start to bring them into conversations and help them try to build the business into something that's there. And in this growth mode, and I'll show it particularly in line with what we do at the Vice Authority, we try to find areas of the business where we can get the number one and number two, or the number two or number three person in that company, in that industry, to be our partner. So we create a natural tension. Because what we don't say in our investment thesis and what we don't say here is when we look to invest in the company, in our investment thesis that we take to our investment committee, we talk about what the exit strategy is. So we never go into a deal not having, at least at the beginning, a good idea of one or two or three companies that would acquire this business. Because if we can't get that, then it's not worth it. And in the realize phase of our investment strategy, we try to realize a return on our investment for our shareholders. Early days, we had 3 investments that we needed to do to qualify to be on AIM as an investment company. One of those was a company called Flexient, which ran out of money. We had a 1% investment. So, it was less than $100,000 in the deal. Their board was struggling with how to deal with the business. They didn't want to invest, yada, yada, yada. Long story short, we made an offer to buy the company. We went in and bought the company for £78,000 for 78,000 pounds of a business. We sold one part of it to a company that became FlexiScale, and up in Newcastle. We kept one business that was FlexiOps, and then we were able to, because of the way we run the business and we're invested in Silicon Valley, sell the other business in 4 months for $500,000 to Ingram Micro. Ingram Micro is the biggest distributor in the world today. We were able to do that because of the network and the capabilities we had. We basically sold the business that we had 70-some thousand pounds into for $500,000. I think it was about a 600% IRR when you figure out it was done in 4 months. So when we talk about realizations, we'll take a realization anywhere we can, but at an IRR that provides us as shareholders a return. What we do, and I won't go into all the detail, but this is our framework, is we really do all of these things with our companies. And we do this right from day one, where we're actively involved in the company. Everybody in our business at Tern has run companies, run sales organizations, been in development. I've run 2 public companies in the US. I've been involved in 3-4 IPOs. And there's a set of experiences that we have like that with everyone else in the business, that we're guys, and I'm from the US, so everybody's a guy. we're people who have seriously been involved in the growth of companies from the get-go. And I like to say have made at least 6 of the infinite set of mistakes you can make, so at least our companies won't do that. And where we really get involved aggressively is in area 2 for growth, where we use our Rolodex, our 6 degrees of sort of separation, and try to connect our companies with other companies that can create a capability to exit the business. So let's do a case study, a real quick case study as I'm running out of time. But this is Device Authority. And this is the journey that we've had within the framework of Device Authority in terms of how we've built the business and built an understanding. And I would like to think for probably one of the smallest companies in the IoT security space compared to everybody else, we're in everybody's top 10 list. This is a company that has done an incredible job of positioning and marketing itself into the industry such that we are invited to every party as a consequence of what this company has been able to do from the positioning of the business and the stuff that we've learned. We're recognized across the board by everybody who counts. And ironically, we were a cool company twice, only company in the history of Gartner to do that, because CryptoSoft was a cool company, Device Authority Inc. was a cool company, and we put them together. I'd like to think we're super cool. But we have over 9 patents that we believe are seminal patents in this area. We have 4, now 5 international patents. And these are patents that really protect the business in terms of making people think about whether they want to do business with us or not. They're also, from a marketable point of view, in Silicon Valley, the rule of thumb is every patent's worth about $1 million to $2 million. And that's what Google pays. And they set what people pay for businesses. So we've got 9 patents, and we had them independently valued by a firm, and it came back at roughly 18 million in terms of 6 of those 9 patents in terms of their economic value to the business. So this is a business that has IP, customers, and products. But what I think is really interesting is this is the area where I think we help the company excel in creating an ecosystem. And this is the ecosystem in terms of the people in the places where we need to have partners or customers such that we're solving the critical problems, not by ourselves, but with other guys. Why is this important? Market education costs a lot of money, takes a lot of time. So if we can get Thales and Gemalto to help us tell somebody why what we're doing is important, that's on their money, not ours. And we have their sales force. So this idea of forming an ecosystem, and we're doing this with all our companies, provides us with this ability to create a low-cost go-to-market strategy on other people's money, or as we used to say, OPM. It's an OPM strategy, other people's money. And it works and it helps. We did a deal with a large manufacturer of medical equipment at Device Authority to secure an extraordinarily important device for them, a new surgical robot, which will be priced in the marketplace at a few $1 million. They wouldn't do business with us, but they did business with Thales. And as a consequence of Thales doing that, we got the deal. What was really important for Thales is they got a deal they probably wouldn't have gotten, and 25% more margin on the deal than they would have gotten if they did it by themselves. So we have their attention from the point of view of getting them a new customer, and we have management's attention by dropping 25p to their bottom line they wouldn't have had if they didn't do this deal with us. That's what we do when we develop value within our companies. Fundamental is our medical device company in terms of they build a haptic toolkit where you get visualization of your operating theater, the particular procedure you're going to do, and have the ability to practice. There are only a finite number of cadavers available. It's really hard to get people to learn how to bring things into the marketplace. I spoke to somebody earlier, but I had a cataract type surgical procedure. I happen to know the guy who invented that. And Kelman did this thing a long time ago. It took him 15 years for that to be accepted as a surgical practice for cataract surgery. And when you think about it, it's nuts because it's really a really simple procedure, but it took that long to train people across the world to learn how to do this thing. Because it was like he would have 6 surgical theaters open in New Jersey, and he'd take a helicopter, and you pay $1,500 as a doctor to get in to learn how to do this procedure. And that's how medicine is still practiced today. A bunch of guys stand around the patient, they wait for a patient to come in with a particular problem, and they get a first shot at it. And then they got to come back again, and maybe they get to close the guy up. And then they come back again, and maybe they get to hold 1 or 2 of the tools. And then if you're having a knee or hip replacement, the salesman from the hip or knee replacement company is in the surgical room with you because he's giving them advice on how to use the drills and the saws. That's how medicine is practiced today. This solves that problem. Our go-to-market strategy, I think, is again, in that environmentally sort of ecosystem way. The original idea from the founders, we're going to change medicine by teaching doctors how a better way to practice. That's very expensive. We said, why don't we go to medical companies and say, you got this new tool, you just spent $2 billion on developing this product. it's going to take you 15 years to make it profitable and accepted. How about if we create a virtual reality capability to train your prospects on this, and we shave a year off adoption? That's $1 billion of ROI to you on that particular product. Are you interested? Much easier sale. And what we do with that sale is we incentivize them to put 25, 50 of the machines in their best hospitals so people can practice. We have a SaaS model. We're working with the Mayo Clinic, for example, to develop other surgical procedures. We can download them to that machine through the cloud and get people to practice. Practice is the key thing here, because when you practice on the machine, it keeps all the data from your surgical process. So we score the physician. And if you want to see a competitive group, these are worse than guys standing in front of a goal on a corner kick. It's unbelievable how they get really upset when they get a yellow score, under 70%. Basically you just killed the patient area. But we're capturing all this data. We feel like within 2 years we'll have enough data for certain procedures so that we can start helping insurance companies write cyber policies. So such that your hospital, St. George's, or your NHS trust can come to them. We call it a FICO score in the US, a financial score. This is how credit is done in the US. It's based on all your credit transactions and your ability to pay. This is a fundamental score for your surgical practice. And what's really interesting, and this is not medical advice, but I take it to heart, if your surgeon's over 50, get a different surgeon. This is what we do from a training point of view. And this is our sales channels, as we talked about. And this is an industry that is getting bigger and better because we're all getting older and are making more body parts. So there's a lot for us to talk about here. But I'm running out of time. I'll let Sarah go so we can have some time for your questions.
Hi, afternoon. I'm just going to give you a quick run through our headlines just so you have a bit of a feel for us as a company financially. Now, as you'd expect, the majority of our net assets sits within the value of our investment portfolio. So I'll whistle through most of those. We've got Device Authority, which makes up about 11.7 million of that. Fundamentals around 2 million, just under. Invimay is about 1 million. And Wild at the moment is a little bit lower down at about 78,000. And we've got a couple of minority holdings there. The difference between the value of the investment and our net assets was primarily cash, actually. At the end of the year, it was about 1.9 million held in cash. We showed a loss of around 300,000 on the year. The reason for the difference between the 2 years is really driven a lot at the moment by Device Authority's valuation. Device Authority is valued, as Al mentioned, in US dollars, and therefore the fluctuation in the currency actually has quite a material effect at the moment. So in 2017, we showed a 800,000 exchange loss, whereas there's a 400,000 exchange gain in 2018, and that really is driving the difference between the 2 years. Year to year, our overheads are actually relatively comparable. And what we've started trying to do is to give some KPIs on the actual performance of our portfolio companies. We're not able to give detailed financial information on them because they are, competitive young companies. It would be damaging for them to actually open their books completely to the market. So what we're trying to do is actually give an indication of how our overall portfolio is performing. And so this is the increase in the turnover is something we will start regularly reporting. In 2017, that was 126. Now, it looks lower in 2018. That was purely because one of our businesses was predominantly operating in the EU grant 2020 environment. So with Brexit, those grants stopped, and FlexiOps actually became Wild Networks, which is now a slightly different business. So if you took that out, it would actually be the like for like would actually be fairly comparable. I think it'd be 122%. Our net asset value per ordinary share dropped a little bit in 2018. Now, in the back end of 2017, we actually took out a convertible loan note, which impacted our net asset value per share. That was retired in early 2018, and actually we had some strong equity funding. We raised about 6 million in terms of equity funds during 2018, and those actually pulled the net asset value per share back up again. So looking at our balance sheet, it's a very clean, simple balance sheet. There is no debt at all, and it is primarily in our investments. And again, the current assets was predominantly cash. So finally, then really our next steps is focused. I mean, Al touched on it when we looked at. We did with Elsop Louis back in 2016 with a combination of Cryptosoft and Device Authority Inc. Our focus really is on expanding our portfolio, achieving realisation, but also really leveraging our position with other strategic partnerships, and it's bringing in new and other partners into our investments so that we enable a mark-to-market valuation of our investments at that time, and actually bringing additional key investors in to join us, which also supports the value of the investment itself, having new investment coming into it, and that's really going to be our focus over this coming year. So I think that's everything from me. So any questions for anyone, for myself or for Al?
You talked now about control, or your ability to exert control. And clearly that's a slightly grey area in terms of, what does that mean? Do you have a chairman? Do you have a non-exec board seat? Do you have a certain minimum percentage of shareholding that you're prepared to take? Where do you draw the line there?
We draw a line in terms of how we structure the Articles of Association so that we have investor voting rights. We make sure that our position puts us in position from an investor voting rights perspective to make sure that what we want to do, we can do. We take the chairman position or depending upon the business, at least 2 board seats. So we have voting rights on the board. And then the other part of it is I think we develop relationships with the people involved so they trust us. And we provide them with incentives for things that we expect them to do. So we create behavioral outputs that are incentivized numerically.
Okay. That was going to my next question, actually. How do you ensure that your investees take part in this ecosystem that you're looking to build? Can you put that in place in terms of a contract, or is it more of a sort of an informal relationship?
We're structured like a U.S. startup. We structured them like U.S. startups. It's a meritocracy. People are given stock options. Those stock options vest over 3 to 4 years. And the stock option is predicated on what we believe to be your future value to the business. If you don't deliver the future value, you're not going to be with the business. And we're very, very quick to deal with decisions on contribution. So if you're not contributing, you're taking air out of the room. We can't afford that. And we bring that methodology to every one of our businesses.
Kind of loaded question. It strikes me that the likes of Device Authority, FundamentalVR could be very large businesses in their own right. To what extent do you believe that could be the case?
I won't give you numbers, but because that's bad. But at one the regulatory guys would kill us. But yeah, it's recorded. But I mentioned this at the AGM, and I'll mention it here. I worked for a period of my career for a short time at U.S. Venture Partners. So I think they have like $5 billion under management now. But we funded it when I was there, things like Checkpoint and things of that nature. And Erwin Fetterman was the sort of dean of that venture firm. And he said, working with a startup is like watching a space shuttle launch. 3, 2, 1, boom. A lot of smoke, a lot of fire, things flying all over the place, but the damn thing just sits there on the launch pad. About 10 seconds later, it's got about 4 feet. And he says, that's the most critical part, because if it falls over, we just wasted all this money. But he said, in about 60 more seconds, it's doing 25,000 miles an hour, and it's a moonshot. And so I think when I look at Device Authority and Fundamental, and we all think, these are space shuttle kind of programs. We have access to companies that are looking for this help to be a player in the U.S. I mean, the medical business is big in the U.K. NHS is the biggest employer, but all the money gets spent in the U.S. And if we can get Fundamental into the U.S. and U.S. successfully, it's 3, 2, 1, boom, and then we go. But getting them in the U.S. and getting partners like some that we've announced already and more really changes the complexion and the risk of the thing wobbling. At Device Authority, it took us a while to understand the asymmetries that we were creating for ourselves. We're now focused. I feel pretty good. We avoided hitting the gantry on the way out. That's a miracle. And I think as we move forward, I'm really excited about Wild Networks. We haven't talked about them, but Wild is a combination of an acquisition we made at a very low cost and FlexiOps, and I think that's it. That will be the next kind of fundamental thing that we'll be talking about by the end of the year, because it solves a problem that is really hard to solve. It's where the internet stops. One more minute, but Levi Stadium is in the U.S. It's built in Silicon Valley. I don't know how much money Cisco spent on that place in terms of scoreboards, Wi-Fi, connections, blah, blah, blah. If you go to a football game there, American football game there, you can't get cell phone coverage. You can't get on your cell phone. You can't even talk to the guy five rows away because it falls over. Too much traffic. Wild Network solves that problem both in areas like that as well as in agriculture, where we can put sensors all over the field and provide real data from the field over Wi-Fi type networks through this business. So Wild Networks is the new opportunity, I think, that we will also be putting on the gantry here this year. Thank you. Thank you.